So let's start. The very first accounting paper of ACCA, that is financial accounting. The basic accounting paper. In ACCA, we will be having three papers into accounting. One is financial, other paper will be at skill level like financial reporting. And then there will be an advanced level paper at strategic level, strategic business reporting. So in this paper, we will learn about the basics of accounting, not very basics, middle level basics. So let's start. What is so this paper having about 25 chapters, sorry, 24 chapter, 20 chapters that we need to cover. There are 22 chapters that we need to cover. Obviously, we will be having about 12 to 15 classes. In 12 to 15 classes, we're gonna cover these 20 chapters. If we look at the syllabus, the 90% syllabus is relating to calculation. The 10% syllabus is relating to theory. That we do. In today's lecture, we will start from chapter 1. Probably we will cover chapter 2. We will see if we can cover some part of chapter 3. That's why chapter 1 and chapter 2 we're gonna cover today. And these both chapters 1 and chapter 2 are mainly theory-based chapters. So if we look at the exam paper, your exam paper will be of 2 hours, 100 marks. Out of these 100 marks, the 70 marks will be relating to 2 marks MCQs. There will be 35 MCQs of 2 marks each, altogether 70 marks. And there will be 2 long questions. Long questions mean there will be a scenario. And according to that scenario, you have to again mark multiple choice question mean MCQ, and 50 marks each question will be. So there will be 2 long questions of 15 marks, and these will become 30 marks. So total 100 marks paper. And to pass this paper, you need 50 passing marks. That we will be able to achieve easily if you cover all the classes with me, if you practice all the questions with me. So we will be able to cover these 50 marks easily. We can easily pass this paper if you are covering 100% classes and if you are covering the practice material with me. So let's start straightforward from chapter 1. The name of chapter 1 is Introduction to Financial Reporting. And in this chapter, we will learn about different terminologies, different concepts relating to accounting. So let's start. What is accounting? What is financial accounting that we are going to study? What is a financial accounting? What is financial accounting? Financial accounting means recording and summarizing. Recording and summarizing what? Financial transactions. Recording and summarizing financial transaction. The business performs some transactions. Transaction mean buying, selling. If business was selling some goods, so say business is receiving a cash and delivering goods, there will be a sales transaction. If business was buying something, They are paying a cash and buying a product, that will be called a transaction. And what's the money involved in that transaction, that will be called financial transaction. So financial accounting is about recording financial transaction. Where we record the financial transaction, we record the financial transactions in journal. We record the financial transaction in journal. And after recording that transaction in a journal, we summarize the financial transaction. How we summarize the transaction? We summarize the financial transactions by preparing financial statements.
Financial statements.
By preparing financial statements. So these are the two main purposes of financial accounting. Financial accounting means recording and summarizing financial transactions. Recording means recording transaction into journals, and summarizing means preparing financial statements. And preparation of financial statements is legally required for all listed companies. I mean, every company have to prepare financial statements. That is mandatory. And that mandatory requirement will be done through financial accounting. There are different components of financial statements, but there are two main components of financial statement. One is called profit and loss account. Profit and loss account, and other is called balance sheet. So these are two main components of financial statement. So what is financial accounting? Financial accounting means recording and summarizing financial transactions so that a company can produce financial statement. Financial statements mean company can produce profit and loss account and balance sheet. There are some other components of financial statements as well. In fact, financial statements is having 5 different components. And the name of profit and loss account is changed now. Its name is a statement of profit and loss account and other comprehensive income. Statement of profit and loss and other comprehensive income. The name of balance sheet is statement of financial position. Statement of financial position. We can abbreviate statement of P&L and other comprehensive income, and we can abbreviate statement of financial position SOFP, statement of financial position. So these are two main types of financial statements, components of financial statements: statement of profit and loss account and statement of financial position. There are 3 others component of financial statements. Just we're gonna name them. We will discuss about them in future. What are other components? Statement of cash flow. Statement of cash flows, SOCF. Statement of changes in equity. Statement of changes in equity, SOCE. And notes to the accounts. So these are 5 main components of financial statements: statement of profit and loss account, statement of financial position, statement of cash flows, statement of changes in equity, and notes to the accounts. But these 2 components are the main components of financial statements: profit and loss and statement of financial position. Can you understand this? So we have discussed what is financial accounting. Financial accounting is about recording and summarizing financial transactions so that company can produce mandatory financial statements. So let's move forward. Why a company need to produce financial statements? Who are the users of financial statements? Mean who use the financial statements? The users of financial statements, the main user of financial statements are company management. Company management mean directors. Why company directors use financial statements? Why they need financial statements? For future planning, to define future strategies of the business, to plan future of the business, they need financial statements so that they can compare current year results with the previous year results. And according to those results, they can prepare future planning, future strategies. So management are the users of financial statements. Investors are the users of financial statements. If any investor want to make investment in the company, he will look at the company profitability from where? From financial statements. Whether company's profits are growing, whether company sales are growing, how much is the profit of the company, because after making investment, he gonna generate return. So return will be generated if company is generating profit. Who else need financial statements? Shareholder need financial statements. Shareholders need financial statements. Who are shareholder? Again, owner of the business. Who else? Company employee are the user of financial statements because their life is attached to the company. So they also need to look at the results of the company, whether company's profitability is increasing, sales increasing. This means their life is secure with the company. Who else need financial statements? Customers sometimes want to look at the financial statements, especially the big customer, large customers, because they want to maintain a long-term relation with the company. So if company's profitability is high, company is improving, company is stable, this means they can make a long-term relationship with the company. Who else need financial statements? Lenders. Lenders mean bank, who provide a loan to the company. They also see the financial statements, mean how much loan company have already obtained. And if company have already obtained too much loan, this means in future might be company unable to pay back the loan. So they also need financial statements. Who else? Suppliers. Suppliers. Who are suppliers? Who provide you goods on credit. Suppliers who supply you goods on credit, they also need financial statements. They also look financial statements regarding company sales, company profitability, company growth. Who else are the user of your financial statements? Government. Government mean taxation department. They need to see company's results, whether company, if paying a company tax, they will see how much is the profit, and if company paying tax, that tax is accurate or not according to profit of the company. Who else? General public also need financial statements. General public. Who are general public? Like accountancy students sometimes need to look at the financial statements of the company. Or if your company is a big employer, big company in the country, obviously they also have interest in company financial statements. Like if company results are better, this means this company will be stable. Will be stable mean economy will be stable. And if a big company is not generating sufficient profit, this means this company business can close down in future. And if this business will be closing down, this will affect economy of the country. That's why sometimes general public need to look at financial statements of the company. Who else? Competitor. Who are competitor? Those who are selling similar products of your business. They also look at your financial statements, mean how is your performance, so that they can compare their performance with your business, whether they are performing better or you are performing better. Like Pepsi, Coke, they look for each other financial statements. So what is a financial accounting? Recording and summarizing financial transactions, mean preparing financial statements. Who are the user of financial statements? Mainly management, directors for future planning, investor to look at profit for deciding investment decision, customer to see whether they can maintain long-term relation, employee whether they can have long-term relation with the company, mean their job is secure or not, general public from economic point of view, especially the big companies, competitors to compare performance with your business, government for taxation purpose, bank for lending decision purpose, supplier whether business will be able to pay amount on time or not. So these are the users of financial statements. Let's move forward. These are the users and why they need financial statements. Everything is explained that you can read by yourself after that. So let's move forward. So which of the following user, test your understanding one. Which of the following user do you think require the most detailed financial statements to be made available to them? Who need more detailed financial statements? Means some of the user might be looking at one component of financial statements, mean only profit and loss account. Some might be at balance sheet, but some user need to see all the components of financial statements, mean in more detail. Who are those? Company management mean directors, because they need to make future decision. So they need more detailed information in the financial statements. Compactor might be just looking at the assets. Trade union mean group of employees. If employees of the company make a group to protect their rights against the company, that group of employee is called a trade union. An investor obviously might be looking at the profitability only. Okay, let's move towards how many types of businesses are there, because we are going to learn about accounting, and in this paper we will learn how to prepare accounting for different types of businesses. So there are mainly three types of businesses. One is called sole tradership, also called sole proprietorship, partnership, and limited liability company, also called joint stock company. Limited liability company are also called joint stock company. So there are three main types of businesses. Sole tradership. Sole tradership means single owner business. It is the simplest form of business. It is owned and operated by one individual, means single owner. He is having all the investment in the business and he is enjoying all the profits of the businesses. He is managing the business by himself. That is called sole trader. For example, shop. Small shop is example of sole tradership. In sole tradership, the owner's liability is unlimited. Owner's liability is unlimited. What does that mean? In case business incurring losses and business need to pay off debts to different parties, the owner personal property will be used. To pay off the debt of the business. This is called owner is having unlimited liability. Mean in case of losses, if business pay to debt of different parties, and by selling business assets, that debt will not be paid fully. So the remaining debt will be paid by selling personal property of the owner. This is called owner is having unlimited liability. Mean his liability is not restricted to the amount of investment. In case of losses, his personal property can also be sold. This is the biggest disadvantage of sole trader business. What is partnership? Partnership is a business where two or more people have invested the money together. They all are running the business and they are sharing profit as per agreed terms. So profit sharing is as per agreed terms, mean they have decided the terms who will get how much percentage of profit. Might be some owners have invested 50%, some have invested 10%, some have invested 30%. Profit sharing could be according to their percentage of investment or could be according to agreed terms. Because might be some partners are putting more time in running of the business, some partners are putting lesser time. This means the person who is putting more time, he will get more percentage of profit. The person who is putting lesser time, giving less time, he will get less percentage of profit, but profit will be shared as per agreed terms. So this is called partnership. In partnership, even the partner's liability is unlimited. Unlimited liability means in case of losses, their personal property can be sold to pay off debt of the company. So can you differentiate between sole trader, single owner business? He is managing the business alone. He is enjoying all the profit. Partnership where two or more people have invested the money and they are running the business and they will share profit as per agreed term. And in both sole trader and partnership, owner's liability is unlimited. Partner's liability is unlimited. Unlimited means it's not restricted to the amount of investment only. In case of losses, their personal property can be sold to pay debt the company. The third type of business is called joint stock company. What is joint stock company? In a joint stock company, the owners are called shareholder. The owners are called shareholders, while the management who is managing the company are called directors. Mean in partnership and sole trader, owners are managing the business, but in joint stock company, owners are different, mean shareholders are different, and management directors are different. Mean owners have given their company to their directors, managers to manage the company. And company is a separate legal entity. Company is a separate legal entity. Separate legal entity mean artificial person in a society. Artificial person in a society. If anything is owned by the company, that is of company rather than owners. If there is any liability of the company, that is of the company rather than owners. That's why the owner means shareholders are having limited liability. Limited liability mean in case of losses, their personal property cannot be used, cannot be sold to pay off debt of the company. Only the company asset will be used to pay off the debt. If the assets are less, debt is more, their personal property will not be affected. Because their liability is up to the amount of investment only. And this is the advantage of having a company. So the main difference between sole trader, partnership and company are sole trader and partnership, the owner's liability is unlimited, while in a company, owner's liability is limited. Why? Because company is a separate legal entity, mean artificial person in a society. Owners are different than company. Who is managing the company? Directors managing the company. In this paper, financial accounting, we will learn the accounting relating to sole tradership and relating to company. The accounting relating to partnership is not in our syllabus. But we will assume any business, either sole trader or company, we will assume it is a separate legal entity, mean assets of the company are asset of the company rather than owners. So what we have learned, the purpose of accounting, the users of financial statements, and three different types of businesses: sole tradership, partnership, and company. So what is the difference between sole trader and partnership? In sole trader, the property of business is owned by one person, while in partnership, there are many persons, two or more. In sole tradership, all the money for the business will be provided by one person and he will enjoy all the profit, while in partnership, the money is invested by two or more persons and they all will enjoy the profit. In sole tradership, any party can sue the business with the owner name, while in partnership, any party can sue the business with partner's name. And in sole tradership, normally it is difficult to obtain a loan, while partnership or company can easily obtain loan by providing some securities. And taxation, normally sole traders are tax exempted, while partnership business is having to pay more tax. Now moving towards different concepts. The framework. What is the framework? We need to prepare financial statements as per accounting standards. So we need to prepare financial statements as per accounting standards. In accounting, there are different accounting standards. Standards mean rules that will provide guidance how to prepare financial statements. Those accounting standards are IAS, International Accounting Standard, are called IFRS, International Financial Reporting Standards. The old standards are IAS and the new accounting standards are IFRS. IAS stands for International Accounting Standards. IFRS stands for International Financial Reporting Standards. So being an accountant, we need to prepare financial statements as per accounting standards. Accounting standard mean as per IAS, IFRS. Who define the accounting standards? There is a body in America called IASB. Stands for International Accounting Standard Board. International Accounting Standard Board. This board define the IAS, IFRS, or prepare the IAS, IFRS. Mean who prepare accounting standards? IASB. IASB stands for International Accounting Standard Board. International Accounting Standard Board. And when IASB define any accounting standard, they also define a guideline help book. Mean how to follow that standard, how to comply that standard, how the standards rules will be applied. There will be a guideline or a help book along with accounting standard. So this concept, like we need to prepare financial statements as per accounting standard, who define accounting standard, IASB, how we can comply with accounting standards. There is a help book. That concept is called the framework. And about this, we will learn in more detail chapter 2. In fact, chapter 2 is complete about this, the framework. Why this framework has been defined? So that all over the world, accountant can prepare financial statements in similar manner. So that the accountant should be aware, should understand how to prepare financial statements. Why we need to prepare financial statements? Because this will help the users of financial statements to make better decisions. And there is another concept called prudence. What does that mean, prudence? There are 5 account heads: assets, liabilities, equity, income, expenses. There are 5 types of account heads. Assets. Assets mean building, machinery, furniture, motor vehicles, land. These are called assets. Liabilities that we need to pay, like loan, leases, payables. Equity, the owner investment into the business is called equity, also called share capital. Income means sales, or expenses mean expenditure, like we are paying electricity expense, we are paying fuel expense, or there could be some salaries, wages, or purchases. These are called expenses. There are 5 account balances: assets, liabilities, equity, income, and expenses. These income and expenses
So,
are recorded in a statement of profit and loss account, while
sir,
assets,
equity is also
liabilities,
known
and
as capital.
capital is called equity is called capital.
Okay, sir.
Equity is called capital. So income and expenses are recorded in statement of profit and loss account, while assets, liabilities, and equity mean capital. They are recorded in statement of financial position, mean balance sheet. We will never record asset in profit and loss account. We will never record equity, liabilities in profit and loss account. In the similar manner, we will never record income and expenditure in statement of financial position. If suppose company is preparing financial statement, to attract the investor, they always try to highlight their profit. Because if company's profits are more investors will be attracted to the company, mean there will be more investment for the company. How company can highlight their profit? If they overstate the income and understate the expenses, they can highlight their profit. You know? In the similar manner, company always try to show strong financial position. How company can show strong financial position? By overstating the assets and understating the liabilities and equity. In some time, company management make a fraud while preparing financial statements. What kind of frauds? To show more profitability, they overstate the income and understate the expenses. Overstate the income and understate the expenses. And to show strong financial position, they overstate the asset and understate the liabilities and equity. What this prudence concept says, while preparing financial statements, assets and income should not be overstated, and liabilities expenses should not be understated. Mean company should prepare true financial statements. Assets, income should not be overstated, and liability expenses should not be understated. This is called prudence concept. So that user can make better decision. So prudence is the exercise of caution when making judgments under condition of uncertainty. This has to ensure that assets and incomes are not overstated in financial statements, and liabilities and expenses are not understated, that company management sometimes try to do. So can you understand this prudence concept? Now moving forward. While preparing financial statements contains 2 types of characteristics. One is called quantitative characteristics. Quantitative characteristics. Other is called qualitative characteristics. Quantitative characteristics mean numbers, amounts, should not be over or understated. Means should be accurate. And management, while preparing financial statements, have to fulfill the qualitative characteristics as well. Mean who prepare financial statements? Company management mean directors. Not only one director, all directors are responsible for preparing financial statements. All directors equally responsible for preparation of financial statements. And while preparing financial statements, they should meet both characteristics. Quantitative relating to number, amounts should not be under overstated, should be accurate. And they should also meet some qualitative characteristics. What are the qualitative characteristics? Qualitative characteristics are of two types: fundamental qualitative characteristics and enhancing qualitative characteristics. Fundamental qualitative characteristics and enhancing. What are fundamental? Relevance and faithful representation. Relevance means financial statements should be relevant to financial records. Financial statements should be as per financial records. Financial records mean journal entries that you have recorded. And faithful representation mean should be accurate, should be true and fair. Mean there shouldn't be any errors in the financial statements. So what are the qualitative characteristics? There are two types of qualitative characteristics: fundamental qualitative characteristics and enhancing. Examiner could ask in the MCQs. They can provide you list and they can ask you what are the fundamental, what are the enhancing. So there are two fundamental qualitative characteristics: relevance and faithful representation. Relevance means financial statements should be as per financial records. And faithful representation means financial statements should be accurate, true, and fair. What are the enhancing qualitative characteristics? Comparability. Comparability means financial statements should be comparable as per previous year. Meanwhile, preparing financial statements, you need to show figure for current year as well as previous year, so that user can compare current year figure with the previous year to see whether there is any improvement or decline in figures. What are the enhancing qualitative characteristics? Financial statements should be verifiable. Verifiable mean an auditor must audit the financial statements, mean verify the figures and provide a report whether these figures are accurate or not. If there is no audit, financial statements are not verifiable. And financial statements should be timeliness. Timeliness means should be prepared on timely basis, like on yearly basis. And understandability mean if there are different terminologies used in the financial statements, those terminologies meaning should be explained. Meaning of terminology, so that any layman can understand the financial statements easily. What does that mean? So while preparing financial statements, management need to meet quantitative characteristics as well as qualitative characteristics. Quantitative characteristics mean prudence. Assets, income should not be overstated. Liabilities, expenses should not be understated. While qualitative characteristics are of two types: fundamental and enhancing. Fundamental are relevance and faithful representation, while enhancing are comparability, verifiability, timeliness, and understandability. Let's move forward. Their meanings are explained there. You can read by yourself. Now we are moving towards definition of elements of financial statements. What is mean by asset? Asset is a present economic resource. Economic mean money farm resource in money terms, controlled by the entity as a result of past event. Mean in the past company have done something. Done mean either construct this, either bought this, and that is under control of the business. So that economic resource that is controlled by the business as a result of past event, mean construction or buying, that is called asset. For example, a building that is owned and controlled by a business and that is being used to house its operation and generate revenue would be classed as an asset. And the purpose of asset is to generate revenue, mean income. Mean business use their asset. Why? To generate revenue, mean income. What is meant by liability? Liability is a present obligation of an entity. I mean, this is obligation imposed on the business to transfer an economic resource. Mean you need to pay against it. Transfer mean you need to pay. Economic mean money resource as a result of past event, and this liability is a result of past event. Meaning the past might be you have taken some benefit and now you have to pay the money. That's why it is your present obligation to pay money resource as a result of past event. Mean in the past you have taken some benefit. For example, an unpaid tax obligation. Mean in previous year you have generated a profit and now you have to pay the tax amount to the tax authority against that profit. Or a bank loan is a liability. Mean you took the loan for whatever purpose, you use that money and now you have to pay that money. So bank loan is a liability. Tax payable is a liability. What is equity? Capital. This is the residual interest. Residual mean left. Interest mean profit. Suppose company made a profit of 100,000. Company made a profit of 100,000. Company normally do not distribute all the profit to their owners, mean shareholder. Suppose out of this 40,000 company paid to shareholder and the amount of profit paid to shareholder is called dividend. The part of profit company pay to shareholder owners is called dividend. So if company has paid 40,000 as dividend, how much is remaining? 60,000. That 60,000 will be called as reserve or will be called as retained earning. And company will add this retained earning to equity. That's why it is called residual interest, mean left profit, mean after paying a dividend, what the profit left that will be part of equity as well as the initial investment capital of the owner is a part of equity. So this is a residual interest, mean less profit in the asset of the entity after deducting all liabilities, mean paying expenses. It is effectively what is paid back to the owner shareholder when the business ceases to trade. Mean this will be paid to the owner when business will shut down, business will close its operation. Until then, business will keep this within the business. So can you understand what does that mean? Residual interest mean left profit. Left profit mean after paying dividend, what is left? Retained earning is a part of equity. What is income? What is income? This consists of increase in asset. Asset mean cash. Or decrease in liabilities. Or you have sent some goods instead of money, so that liabilities decrease. That result in increase in equity. Obviously, if we generate a profit, that profit will be added to the equity, the residual interest. So this will increase equity. Other than those relating to contribution from holder of equity claims, mean this is a part of profit, not a shareholder investment. This can be achieved, for example, by earning a sales revenue or through increase in value of an asset. Asset mean again sale, you are generating cash. What is expense? This consists of decrease in asset, mean you are paying a cash. So cash is decreasing, asset is decreasing, or increase in liability. If you haven't paid the cash, this means you need to pay in future, so your liability will increase. That result in decrease in equity. Obviously, expense will decrease the profit. Decrease the profit mean decrease the residual interest, mean left profit mean equity. Other than those relating to distribution of holder of equity claim, this can be achieved, for example, by purchasing goods or services and other entity or through the reduction in value of an asset, mean you are paying a cash. Why? You are purchasing some goods or services. Note, economic resource a right that has the potential to produce economic benefit, mean in money terms, simple. Now, if we look at different types of assets, so there are two main types of assets, non-current assets and current assets. Non-current assets and current assets. Let's see how we can prepare balance sheet. Statement of financial position. Balance sheet is called statement of financial position. As at 31st December 2023. And before this, we write company name, suppose ABC company. So while preparing balance sheet, financial statement of financial position, what we need to do, we need to state non-current asset first. Then we write current assets. What we do, we make their total, it will be called total assets. Then we record equity and liabilities. Equity and liabilities, first we record equity. Then we record non-current liabilities. Then we record current liabilities. And then we make the total of all these three, equity, non-current liabilities and current liabilities. And that total will be called total equity and liabilities. And this total should always be equal to total assets. So there are two main components, two parts of balance sheet, assets and equity and liabilities. Assets are of two types, non-current assets and current assets. What are the non-current assets? Those assets that provide us benefit in more than 12 months are called non-current assets. So those assets that provide benefit in more than 1 year are called non-current assets. What are those? Land and building, plant and machinery. They are also called fixed assets. Motor vehicles, furniture and fixtures. So those assets that provide us benefit in more than 1 year are called non-current assets. And those assets that provide us benefit in less than 1 year, mean they can be converted into cash within a year, are called current assets. What are the current assets? Inventory means stock, receivables. Receivables mean the amount we need to receive from the customer because we sell them the goods on credit basis. So that will be called receivables. Cash, either in hand or in bank. One other thing is called prepayments. What are prepayments? If suppose next year expenditure we have paid in advance, expenses paid in advance. So that will be our asset, mean we can receive that amount if we are not gonna take the benefit. So we will record it under current assets in balance sheet. Prepayments. Prepaid expenditure mean expenses paid in advance. Mean we have paid the money in advance, that will be called prepayments. Current assets. Then we need to record equity. Equity mean share capital. Share capital mean the amount owner invested into the business is called share capital. And the part of profit that we haven't distributed to the shareholder, keep it as reserve, is called retained earning. So we will record retained earning under the head equity. And then we need to record non-current liabilities and current liabilities. What are non-current liabilities? Liabilities that need to be settled in more than 1 year. Liabilities that we need to pay in more than 1 year are called non-current liabilities. And liabilities that we need to pay within 1 year, within 12 months, are called current liabilities. What are long-term liabilities? Bank loan, leases, debentures. What is debenture? We will discuss in future. This is our long-term liability. What are the current liabilities that we need to settle within 12 months? Payables. Payables mean if we bought goods on credit from a supplier, that will be called payables. Bank overdraft. What is bank overdraft? Sometimes bank allow us, if your account balance is zero and you need to pay money to some party, you can pay from your bank account, mean your bank account balance will become negative. That you can deposit into the bank afterward. So that bank overdraft is also a current liability. What else will be current liability? Expenses payable. That are also called accrued expenses. What does that mean? If suppose current month mean December month electricity bill we gonna pay in January. This means we have enjoyed the benefit of that electricity in December, but we haven't paid the amount. We're gonna pay the amount in next month in January. So we will record it as current liability like accrued expense or expense payable. What are prepayments? Expenses paid in advance. What are the accrued expenses? Expenses not yet paid, mean we're gonna pay cash for them in future. So we will record our liability, mean this is our obligation that we need to transfer as a result of economic resource. So can you understand the difference between non-current assets and current assets? The difference between non-current liabilities and current liabilities? And we have discussed just two components of equity. There are other, but we have just discussed two. So what are the assets? Non-current and current assets. Non-current assets are of two types. tangible and intangible. Tangible and intangible. Tangible that we can see as well as touch. Land and building, plant and machinery, motor vehicle, furniture and fixture. These are all tangible non-current assets. What are the intangible non-current assets? That we cannot touch or see. What are those? Goodwill, copyrights, patents. What are these things? We will learn in future. Just remember the name. Intangibles, those assets that cannot be seen or touched. Examples are goodwill, copyrights, and patents. So non-current assets could be either tangible, intangible, acquired on a long-term basis. Long-term mean more than 12 months. They will provide us benefit in more than 12 months, more than 1 year. Used in producing service to the business, not held for resale in normal course of trading, mean we not gonna sell them, we're gonna use them to generate revenue. Not expected to be realized within 12 months, mean these will not be sold within 12 months, will not be converted into cash within 12 months. Example, land and building, motor vehicle, plant and machinery, etc. What are the current assets? Assets expected to be realized, sold, for consumed within the normal operating cycle, mean within 1 year. Realized within 12 months after the reporting period, are held primarily for trading, mean we're gonna sell it like inventory. Inventory, receivable, cash are the examples of current assets. What are the difference between non-current liabilities and current liabilities? Non-current liabilities, liabilities that have not been classified as current, our payment can be deferred unconditionally for more than 12 months. We're gonna pay against them in more than 12 months. Examples, loan, leases, or debentures. Debenture is a type of loan. What are the current liabilities? Liabilities that are expected to be settled within the normal operating cycle. Normal operating cycle mean 1 year. Held primarily for trading or is due to settle within 12 months reporting period. There is not an unconditional right to defer settlement for at least 12 months, mean we cannot defer, mean transfer to more than 12 months. For example, payables, bank overdraft, or short-term loan. Short-term means 3, 6, 9 months loan, or maximum up to 12 months loan. The long-term loan like 5-year, 10-year loan will be classified as non-current liabilities. Test your understanding too. Classify the following item into current and non-current assets and liabilities. Just see and write down which one is non-current assets, which one is current assets, and which one is liability. Please try by yourself. So land and building, what is that? Non-current assets.
It's a non-current asset.
Receivables.
Receivables, current asset. Cash is also
Cash.
current asset.
Current assets. Loan
Loan
repayable in 2
liability.
years time.
Liability.
Non-current
Non-current asset.
liability.
Non-current liability.
Payables. Current
Payables.
liability.
Current liability.
Delivery
Delivery
van.
van.
Motor vehicle.
Non-current asset. Non-current
Non-current
asset.
assets. So there are 5 components of financial statement. Statement of financial position. We have discussed how to prepare that. We will start with the non-current assets, where we record property, plant and equipment, mean all tangible non-current assets, and then current assets, inventory, trade receivables. We will make total of assets, and this total should be equal to total of equity and liabilities. And then we record equity, share capital, share premium, revaluation surplus. What are these things? We will learn in future. Retained earning, part of profit that is not distributed to shareholder. So total equity. And then non-current liabilities mean bank loan, current liabilities, trade payables, bank overdraft, income tax payable that we haven't paid yet, and interest accruals, interest that we haven't paid yet. So this is the total of equity and liabilities. 110,700 should be equal to total assets. How to prepare statement of profit or loss and other comprehensive income. We will start with the figure sales revenue. Out of sales revenue, we will deduct cost of sale. We will arrive at gross profit. Sales less cost of sale is equal to gross profit. And from gross profit, we will deduct a different expenditure like distribution expenditure, selling and administration expenditure, finance cost mean interest. We will arrive at profit before tax. And from that, we will deduct income tax. We will arrive at profit for the year. This is also called profit after tax. And then there are some
It's also
other
called net profit
comprehensive.
now, sir.
Yeah, this is the net profit.
Okay.
So then we record some other comprehensive income. So we will arrive at a total comprehensive income. Mean profit and loss account is up to this point. And this part is relating to other comprehensive income. How to prepare statement of changes in equity, we will learn in future, not now. How to prepare cash flow, we will learn in future, and notes of the accounts, we will learn in advanced level papers, not here. To keep things simple. Now moving towards some 2-3 small topics, and then this chapter will be ended. Materiality. What does mean by materiality? Materiality, simple words mean important. Or you can say large account balance. Material mean important, large or big account balance are called material. Materiality concept says items are material if they influence economic decision of user. Items are material if they influence economic decision of user. Mean in the financial statements, those account balance will be considered material if they influencing any decision of user. Mean big account balance will affect the user decision. If you change any of the big account balance, that will affect the financial statement as well as decision of user. If there are any small account balance, mean amount is small, those will not be called material. Suppose if any asset is recorded as 100,000 and management try to overstate it and they recorded it instead of 100,000, they have recorded it on this amount. This was the original amount and they have recorded on this amount. By how much the asset is overstated? Just 10. Is that a 10 material? No. Why? Because it is not influencing decision of any user. But if management instead of 100,000 have recorded the asset on 200,000, how much amount they have overstated? 100,000. So this 100,000 will be called material because this is influencing the decision of user. This is having a big impact on the financial statement. So materiality means important, big, large effect on the financial statements. Mean those items are called material if they are influencing the financial statements or influencing the user of the financial statements while making a decision. Obviously, if profit is 100,000 instead of assets, if suppose profit is 100,000 and they have overstated the profit by 10, this will not affect the user. But if they have overstated the profit by 200,000, mean by how much they have overstated, they have overstated by 100,000. So this will be called material. Mean having material misstatement in the financial statement. So what does material mean? Important or large effect. An item is regarded as material if its omission or misstatement, mean over or understatement, is likely to change the perception and understanding of user of that information. Mean affecting the user decision making, mean understanding. The rest of the thing you don't need to study. Just focus on what is materiality. Items are material if they influence economic decision of user. Economic mean decision relating to money terms. There's another concept called substance over form. What does that mean? For recording transactions, there are two forms. One is called legal form. The other is called economic reality. Legal form and economic reality. We need to record a transaction as per economic reality rather than legal form. According to substance over form, if we summarize, we need to record transaction as per economic reality rather than legal form. What does that mean? Suppose if company has lease a car for 5 years. So this means you need to pay the money for car in 5 years. For next 5 years, this car is your ownership or under the ownership of bank. It will be under the ownership of a bank. This is the legal form. In what law says, until you haven't paid the full amount in installment, the ownership is of the third party, mean bank, not your. But we record these leases as economic reality, mean we record this car under your assets of the company. Though it is not in your ownership, but we are recording as asset. And against asset, we will record the liability as well, that we need to pay back to the bank. What is the legal form? What is the legal reality? The bank is having ownership of this car because you don't have control over that car. That's why you cannot record asset, but we record transaction as per economic reality rather than legal form. Mean we will record the car under your asset and the amount we're gonna pay to the bank will be recorded as a liability. After 5 years, obviously this will be our asset because we have paid all the amount. This will be our asset. There will be no liability. So this is called substance over form. Mean we record the transaction as per economic reality rather than legal form. So as noted earlier, if information is to be presented faithfully, the economic reality must be accounted for. Mean we account for transactions on economic reality and not just the strict legal form, mean not on the legal form. And there is another example. Shares are of two types. Company shares are of two types, ordinary and preference shares. Ordinary and preference shares. Ordinary mean normal shares. And against normal shareholder, company pay dividend. Part of profit, company pay dividend. Sometimes companies are having different losses. Obviously, you will pay dividend if you are having profit. If there is no profit, company will not pay dividend to ordinary shareholders. In company pay dividend to whom? Ordinary shareholders. Ordinary mean normal shareholders. If company is having profit, company will pay dividend to ordinary shareholders. If there are no profits, company will just give a smile to the shareholders. Sorry, we cannot pay dividend because we don't have profit. And suppose company incur losses for the current year, but company need money. And in case of losses, you cannot get money from the bank loan. You can get money from the shareholder. But if you are having losses, shareholder will not buy your shares. But you need money to survive the business. And your ordinary shares, nobody willing to buy because you are not paying dividend, you are having losses. In that case, company sometimes issue preference shares. In preference shares, company give guarantee to pay dividend. Either company is making losses, we will pay you dividend. Obviously, to ordinary, in case of profit, company will pay dividend. But to preference, company give guarantee, we will pay you fixed dividend. And the dividend percentage will be fixed. If you are suppose paying us 100,000, we will pay 10% as a dividend, and that will be paid either we are having profit or loss. So that company can generate money from the shareholders. And these preference shareholders company also give guarantee not for dividend. We will repay your money, suppose after 5 years. To ordinary shareholders company never ever pay money back. They can receive their money by selling shares in the market or at the time of company death. Otherwise, their money company will never pay back. But for preference shareholder, company give guarantee we will repay your money after 5 years and we will pay you fixed dividend as well. Though these preference shares are shares, we should record under equity. This is their legal form. But the economic reality is that we have like obtained a loan from the shareholder in terms of preference shares that we need to pay back. So we will record it as non-current liability rather than shares. I mean, we'll record it as a debt. Their legal form, these are shares, should be recorded under equity. But economic reality is that we are treating them as a loan. We are paying them fixed dividend, mean interest, and we need to pay them after 5 years. So we will record it as a debt. This is the economic reality. And this example they have explained here. An example of substance over form that you will encounter later in the tax in the accounting treatment of redeemable preference shares. Although on legal form they are shares, there is an obligation to repay the preference shareholder, and so they are accounted for as a debt mean liability. This is the economic reality. We record a transaction on economic reality rather than legal form. There is another concept called going concern. What does that mean? Going concern mean business will continue its operations. Business will continue its operations in next foreseeable future. in next foreseeable future. What does that mean, foreseeable future? Foreseeable future mean next at least 12 months. A company will be called going concern when business will be continue in next 1 year, in next 12 months. If business will shut down its operation within 1 year, mean in next 12 months, that company will not be called as going concern. What is mean by going concern assumption? Going concern mean business will continue its operation in next foreseeable future, i.e. next at least 12 months. And according to this going concern concept, if company is going concern, prepare financial statements on going concern basis. Going concern basis mean normal. What are the normal financial statements? You need to show non-current assets, current assets, non-current liabilities, and current liabilities. And if company is not going concern, if company is not going concern, mean business will be shut down in next 12 months. In that case, company need to prepare its financial statements on breakup basis, not on going concern basis, mean not normal. What does mean by breakup basis? You have to show all the non-current assets as current assets, and you have to show all the non-current liabilities as current liabilities, because you have to pay within 1 year. You have to sell your asset within 1 year. So what is going concern basis? Going concern means business will continue its operation in next 12 months. If it will continue in next 12 months, this means business is going concern. So they will prepare their financial statements normal. And if there are chances business will shut down, will cease operation during 12 months, this means business is not going concern. And if business is not going concern, they need to prepare their financial statements on breakup basis. Breakup basis means they need to show all the asset under current asset, and they need to show all the liabilities under current liabilities. This is the concept of going concern. So financial statements are prepared on assumption that the entity is a going concern and will continue to operate for the foreseeable future, i.e. it has neither the need nor the intention to liquidate or significantly curtail, means stop its operations. And foreseeable future means next at least 12 months. There is another concept called business entity concept. Business entity concept means company is a separate legal entity. Company is a separate legal entity, and company assets are assets of the company because company is a artificial person in society. The asset of company is asset of company rather than owner. I mean, owners are different because their liability is limited up to the amount of investment. And liabilities of company are liabilities of company rather than the owners. I mean, company need to pay the liability rather than owner from their personal liability. This is called business entity concept. Another concept called accrual basis accounting. What is accrual basis accounting? We need to record revenue when they are earned. Suppose this is the year end that started from 1st January 2023 and ended on 31st December 2023. If suppose one of the customer has paid us amount in advance that I will receive goods in January here. Mean we will deliver goods here and we have received cash here. So we should not record a sale here. We should record a sale here when we deliver the goods. Mean revenue should be recorded when we earned them. Here we haven't earned them because we haven't provided something. When we provide something, then revenue will be earned. Before providing something, that is our liability. So revenue should be recorded when we deliver the goods, mean when it is earned, and expenses when they are incurred. Here we have enjoyed the electricity and we're gonna pay here, but we will record expense in December in this year because we enjoyed the benefit here. Though we're gonna pay in future, but we will record it as accrued expenses. So this is called accrual accounting. Mean revenue will be recorded when they are earned, mean when we deliver the goods, but expenses will be recorded when we have enjoyed the benefit, mean when they have incurred. Mean the timing of recording revenue should be on delivery of goods. Before delivery of goods, we will not record revenue. Though we have received the cash, we will not record income or sales. But the expenses we will record when we have got the benefit, though we're gonna pay in future, but we'll record expenditure today. This is called accrual basis accounting. In Prudence, we have already discussed assets income should not be overstated and liabilities expenses should not be understated. There is another concept called consistency. What is consistency? Financial statements should be prepared consistent. Consistent means your accounting policies should be same. Your accounting policies should be same. Year on year basis. Whatever your policy was in previous year should be same in the current year. Be same in the current year. This is called consistency. In your policies, your rules for preparation of financial statements should be same. Though the circumstances changes, should be same. If you're gonna change, you need to disclose it in the financial statements. But try to keep your policies the same year on year basis. Like the depreciation rate, if in previous year was 10%, the same should be 10% in current year. So which of the following statements are correct? Only tangible assets, i.e. those with physical substance, are recognized in the financial statements. Only tangibles are tangible, intangible, both should be recognized. Both should be recognized. This is wrong. Faithful representation means that the commercial effect, mean economic reality of a transaction, must always be shown in the financial statement, even if it differs from legal form. Yes, this is correct. Substance over form. Business only report transaction events and balances that are material to user of the financial statement. No, we need to record immaterial as well. So this is wrong. Which one is correct? True only. Option C. And this chapter has ended now. Let's take a small break. After 15 minutes, we will cover some MCQs on this chapter. So take a break. Yeah.
Okay, sir.
Coming after 15. Hello. Are you
Hello, sir.
there?
Yes, sir.
Okay. So let's discuss some MCQs relating to chapter 1. So MCQ number 1. Which of the following statement is true? The directors of a company are liable for any losses of the company. Are directors liable for any losses of the company? A sole trader business is owned by shareholder. No, there are no
No.
shareholder in partnership or sole
Yeah,
trader.
it's false.
Partners are liable for losses in partnership in proportion to their profit sharing ratio. No, they are liable
Yeah.
for profit according to
Yes.
profit sharing ratio rather than losses.
Losses.
A company is run by directors on behalf of members.
Yeah, company is run by director.
Yeah, option D
D.
is accurate.
Yeah.
Number 2, which of the following statement best defines a statement of financial position? It is a summary of income and expenditure. No, income
No.
and expenditure are recorded in profit and loss account.
Yeah.
It is a summary of cash receipts and payment made during an accounting period. No, this is relating to
No.
cash flow statement.
Assets, liability, and equity at
Assets,
specified date.
liability as equity at specified date, option C.
It's correct.
Because option D is having expenses. Expenses are relating to profit and loss account.
Yes.
Number 3, which of the following statement best defines a statement of profit or loss? It is a summary of assets and expenses. No, income and
No, income
expenses.
and expenditure. Option
It is
D.
a summary of cash receipt. No. It is a summary of assets, liabilities. No. It is
No.
a summary of income and expenditure. Yes,
Option D.
option
Yes.
D. Number 4, which of the following user groups is likely to require the most detailed financial information? Who require most detailed financial information?
The management.
The
Investor.
management.
Yeah. The management.
Number 5, which of the following statement is true? Accounting can be described as a recording and
Recording and
summarizing of
summarizing of
transaction.
funds.
Yes. Financial accounting describes the production of a statement of financial position and statement of profit or loss for internal user. Do we need to produce balance sheet and a profit and loss account for internal user? No, there are
No,
some external
it's
user for
external
whom we
users.
need to also
Option one
produce
only.
that. So 1 is correct and 2 is false.
Not correct. Yes.
Option A,
A.
1 only.
Yeah, one only.
Number 6, what is the main purpose of financial accounting? To record all transactions in the books of accounts. Only recording? No, it's
To
recording as well as summarizing. To provide management with detailed analysis of cost, not only cost. To enable preparation of financial statements that provide information about an entity's
option
financial
C.
performance and position. Yes, obviously through recording, we can
Yeah.
summarize and prepare financial statements. To
Yeah.
calculate profit or loss for the accounting period, not only profit and loss. So option C. Number 7, which of the following statement does not explain the distinction between financial statements and management accounting? Oh, we forgot to cover one topic. The difference between management accounting and
Financial accounting.
financial accounting. Let's discuss this first. The difference between management accounting and financial accounting. Management accounting and financial accounting. Let's differentiate between these two. Purpose. The purpose of management accounting is for internal management only. Mean internal management, they need management accounting for decision making purpose. They prepare some budgets forecast, while the financial accounting is for external user so that they can make a decision. Management accounting is not mandatory, it's not compulsory, but financial accounting is mandatory. By law, company have to produce financial statements. Whether it is required or not. Timing. Management accounts are prepared on a monthly basis, while financial statements are prepared on yearly basis. Format. There is no defined format of a management account. It is on management how they gonna prepare it. But financial accounting should be prepared as per IAS, IFRS. Mean there should be a specific format how to prepare financial accounts. While for management accounting, there is no specified format. It's on management. How they want to prepare, they can prepare it. So these are the differences between management accounting and financial accounting. Financial accounting means preparation of financial statements, while management accounts mean preparing budgets or forecast, mean estimation of future. Now moving towards MCQs again. Number 7. Which of the following statement does not explain the distinction between financial statement and management accounts? Mean financial accounting and management accounting. Financial statements are primarily for external user and management accounts are primarily for internal user. This is accurate. We need to find which is wrong. Financial statements are normally produced annually and management accounts are normally produced monthly. This is also true.
Yeah.
Financial statements are more accurate than management accounts. Financial statements are more accurate than management accounts. Both should be accurate. It doesn't mean management accounts should be inaccurate. No. Financial statements are audited by external auditor. Yes, the audit is
Yeah.
compulsory and management accounts do not normally have an external auditor. Mean there is no audit requirement of management accounts because they are not legally required. So A, B, D are true, but C
It's
is
not
not
correct.
true. Number 8. Which of the following statement best defines a liability? A liability is an obligation arising from a past transaction or event. A
Hmm.
liability is a legally binding amount owed to a third party. A liability is a present obligation of the entity to transfer an economic resource as a result of past events. So this is the definition that we have
Yeah.
learned. The complete definition
Option
A
C.
is not complete. Number 9, which of the following statement best defines an expense? An expense
And
is
explain
an
the
any
outflow of economic
outflow
benefit
of
in an
economic
accounting.
benefit
Yeah.
in an accounting period. An expense is an outflow economic benefit resulting from the purchase of resource in the accounting period. An expense is an outflow of economic benefit resulting from a claim
Expenses
by a
decrease
third party.
liability that
An
was
expense is
adjusted
decrease in
into the.
asset. Mean cash is going or increase in liability. If you haven't paid the
Yeah.
cash, that
The
result
result is
in
decrease in
decrease in
equity other
equity.
than the.
Obviously, profit will be decreased other than
Yes.
those relating to distribution of holder of equity claims. So
Option
B
D.
option is the correct answer. Enough. Number 10. Which of the following statement is true in relation to partnership? A partnership is a separate legal entity. No, company is a separate legal entity. A partnership is jointly owned and managed by partners. Yes, jointly owned and managed by partners. A partnership can raise capital by issuing shares. No, company can issue shares. A partnership is able to own property and other assets in its own name. No, they are on the name of partners, owners. That's why owner's liability is unlimited. So option B is
Sorry.
correct. Number 11, which of the following statement is true in relation to a sole trader? A sole trader cannot have any employee. No, he can appoint employees for his help. A sole trader is able to introduce or withdraw capital from the business at any time. Yes, he can. A sole trader has a limited, no, unlimited liability. A sole trader can operate a business from only one location. No, he can operate from so many locations. So which one is true? Option B, he can withdraw, he can invest any amount whenever he want. Number 12. Which of the following statement is true in relation to a limited liability company? A limited liability company can incur liabilities in its own name. Yes. A limited liability company cannot acquire asset in its own name. No, the asset of the company are on the name of company. A limited liability company cannot incur liabilities in its own name. No, the liabilities of the company are of company liability. And a liability company can be formed on an informal basis. No, there should be formal agreement between shareholder and who will be the manager. So option A is correct. Number 13. Which of the following items could be used to encourage executive directors to operate in the best interest of the company? I mean, they should consider best for the company rather than best for themselves. They could be awarded a high salary. No, it is not necessary. They could receive a bonus based on both individual and company performance. It is not necessary. They could be entitled to large payment on resignation. No. They could be asked to attend annual general meeting of the company. In how directors can consider best for the company, not based on salary, not based on a large resignation payment, not to attend AGM. I think if they are having a bonus based on company performance, obviously they will give a performance to achieve their bonus. So they will get a bonus and company best will be achieved accordingly. Number 14. Which of the following statements relating to a partnership of 20% and a limited liability company with 20 shareholders, each with a 5% shareholding is true? Both partnership and limited liability companies are able to own asset in their own name. No, partnership cannot own asset on business name. The members of a limited liability company have the right to participate in the management of the company. Yes, shareholder can participate as a management, whereas partners do not have the right to participate in the management of the partnership. No, partners are normally managing business by themselves. There is no concept of separate ownership and management. See, the partners have the right to participate in the management of the partnership, whereas members of a limited liability company do not have the right to participate in the management of the company. Yes, in company, we can say management and ownership is different, but partnership is the same. What is option D? Partnership are subject to the same regulations regarding introduction and withdrawal of capital from the business as a limited liability company. No, 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 there are different rules. So option C, we can say, like in a company, management and ownership is different. Though in some cases, owners are also managing the company, being become directors, but it is different. Number 15, which of the following item would not be included in a sole trader's capital? Equity share capital, obviously it's relating to shares. So it is in company rather than sole trader. Revaluation surplus is based on asset, personal drawing, the owner withdraw the money, capital account, the owner investment. So option A, because it's relating to shares, and in sole tradership there are no shareholders, so no concept of shares. Mean instead of equity in sole tradership, equity will be called capital. In case of company, the capital owner investment will be called equity rather than capital. 16. Which of the following pairs of items would you expect to see in the financial statements of a partnership? Dividend paid? No, dividend paid to shareholder. It's in company rather than partnership. Capital account and profit or appropriation account. Yes, the investment of the partners will be capital and their profit distribution is called profit appropriation account. What is C? Profit appropriation and dividend? No, dividend paid to shareholder in company. Share premium and capital? No, share premium is also relating to shares. And in partnership, there are no shares. There are partners. There are no shareholders. The word share is associated with company due to shareholders. 17. Which of the following statement best defines an asset? An asset is a resource owned by the entity with a financial value. Incomplete definition. An asset is a resource controlled by an entity from which a future economic benefit are expected to generate. Yes, this could be definition. An asset is a resource controlled by an entity as a result of past event. Again, incomplete. An asset is a present economic resource controlled by the entity as a result of past event. Yes, this is the correct definition that we have learned. 18. Which of the following statement best defines the equity or capital of business? Equity or capital of business is represented by the net assets of the business. The option A is correct. How we will learn this in future. What is meant by net assets? We will learn in future, but leave this MCQ for now. 19. Classify each of the statement as being true or false in relation to the characteristics of partnership. Each partner has a limited liability. No, partner's liability is each partner has limited liability for debt of the partnership. No, partner's liability is unlimited. A partner is an employee of partnership. Partner is an employee of partnership. No, he's not an employee.
No,
He is a
false.
owner. Each partner is entitled to participate in the management and running of the business. Yes. There must be a formal partnership agreement signed by all partners which specifies the respective rights, duties, and obligation of the partners to each other. Yes, there should be agreement between them. Number 20. Classify each of the following statement as being applicable to either a limited company or partnership. Owners or investor may receive a return on their investment in the form of dividend, where we pay dividend in
Limited
partnership and
liability
company. The business cannot own asset and incur liability in its own name in partnership. Annual financial statements are not subject to external audit. For company should be audited. For partnership, no need for audit.
No.
Loans and borrowings. Loans and borrowings for business may be secured by a floating charge. So in a company, you need to provide some security to get a loan. In a company, you need to provide some asset as a security to get a loan. So it is for the company. 21. Which of the following aspects of financial and non-financial performance and position based upon information in the annual financial statements is likely to be of most relevance or interest to a bank that is considering making a long-term loan to a company? Meanwhile, making lending decision by the bank, what he will see in the financial statement, what he will notice in the financial statements. Who? Bank. Short-term profitability? No, while providing loan for long term, he will see long-term profitability. Solvency, solvency mean bankruptcy or going concern. Yes, he will see. The total of issued share capital in the statement of financial position. No, he is not concerned for share capital. Whether the company has made any changes in senior management during the year. No, he will not see changes in senior management. So he will check solvency, bankruptcy, going concern. 22. Which of the following aspects of financial and non-financial performance and position based upon information in the annual financial statements is likely to be of most relevance or interest to a potential investor? Mean what investor will see in the financial statement? The carrying amount of property, plant and equipment in the statement of financial position? No, management will see that. Solvency, bank will see that. Whether the company has developed a new product to sell? No. Current and future profitability? Yes, he is going to invest, so he will see return based on profitability. Number 23. Which of the following item is the IFRS Advisory Council is responsible for? This is relating to chapter 2. So leave this for a moment. We will cover later on. Is the following statements true or false? International accounting standards are effective only if adopted by national regulatory body. Obviously, if local law will allow how to prepare financial statements, then you should follow those rules. If they say you can adopt IFRS, IAS, it's fine, it's true. Accounting standard provide guidance on accounting for all type of transactions. No, they do not provide guidance for all type of transactions. Some transactions are specifically country to country different. So for that, we need guidance from local laws rather than accounting standards. So it's false. 25. Which of the following is most obvious means of achieving a public oversight of corporate governance? Corporate governance we will also study in chapter 2. And the rest we will cover in chapter 2. So let's discuss chapter 2, then we will move back to the remaining MCQs. So until 22 we have covered. So let's discuss what is chapter 2. A small chapter we will finish and then we will cover the remaining MCQs. So the name of chapter 2 is regulatory framework. We will see how accounting standard will be issued, who are involved in issuing accounting standards. So regulatory framework. Framework means defining standards for the company to prepare financial statements. So regulatory framework for the preparation of financial statements is necessary for a number of reasons, mean why there are accounting standards. To ensure that the need of the user of financial statements are met with at least a basic minimum information, means standard will provide direction to the company how they can prepare financial statements so that all user need can be met. To ensure that all information provided in the relevant economic arena is both comparable and consistent so that all companies can prepare financial statements on a same basis, consistent basis, there are standards that we need to follow. To increase user confidence in the financial reporting, obviously, if a company is preparing financial statements as per standard, this means financial statements are true, it will provide confidence to the user that financial statements are reliable. And to regulate the behavior of companies and direct towards their investors, mean this will provide a direction to the company investors how they can prepare financial statements. The accounting standard, the accounting rules we need to follow to prepare financial statements are of different types. We need to follow national financial reporting standards because some countries do not allow accountant to prepare financial statements as per IAS, IFRS. So the country law defines some standards like a company's ordinance. So we need to prepare financial statements as per national law. Even if we are following IAS, IFRS in preparation of financial statements, we need to follow national laws as well. We need to follow market regulation in industry in which we are operating and the stock exchange rules we need to follow for preparation of financial statements. Mean along with IAS, IFRS, we need to follow some other rules in preparation of financial statements. What are those? National financial reporting standards. If local government have defined standard, national laws, industry regulations, and stock exchange regulations. Security exchange means stock exchange. How the standard has been defined, who are involved in defining standards. So there are 4 bodies involved who prepare or define standards. IASB, International Accounting Standard Board. Along with IASB, there are 3 other bodies working. IFRIC, IC stands for Interpretation Committee. Interpretation Committee. What is the purpose of interpretation committee? Interpretation committee actually interpret, mean explain the accounting standard that is defined by IASB, how to comply that standard. IFRS AC stands for Advisory Council. IFRS Advisory Council. The purpose of Advisory Council is to provide advice to the board if there is any issue with the standard, like the standard is weak, standard is missing some information. So this advisory council will provide advice to the board. Board mean IASB to revise the standard. So IASB prepare and define the standard. IFRS IC Interpretation Committee will provide guidance how to comply the standards for the companies. And IFRS AC Advisory Council provide advice to the board to revise the standard. And all these things are working under IFRS Foundation. What IFRS Foundation is doing, they are governing the process of accounting standard, mean they are monitoring. IASB, IFRS, AC, and IC mean these 3 bodies are working under a foundation called IFRS Foundation. IFRS Foundation is a governing body that will order the board to define the standard. So board has to define the standard. Board mean International Accounting Standard Board, IASB. And they will work as per the order of foundation. And they will define standard or change standard as per the advice of advisory council. And IC is helping the board or helping the companies to implement the standard. So these 4 bodies are involved in standard setting. How the accounting standard is set, mean how the accounting standard is defined. Who defined the accounting standard? IASB. So first IASB mean board will issue exposure draft. What they will issue? Exposure draft for public comments. Mean before defining any standard, preparing any standard, the board mean IASB will issue exposure draft. What is exposure draft? He will prepare raw form of standard. Mean he will write different rules of the standard and will send to different accountancy bodies. Like we are going to prepare this standard. These are the rules. Please provide us your comments, your recommendation. Either there is a need, any need to change any wording, or there is a need to delete any rule, there is a need to add any rule. Please provide us comments. And after public comments, the exposure draft will come back to the board, and board after necessary adjustment issue the standard that will be called IAS or IFRS. Now, being accountant, we need to follow this standard. So what is the process of issuing standards? Process of issue standards, accounting standard. So board IASB first issue exposure draft, mean raw form of standards for public comments. Mean will send it to different accountancy body in the public. They will comment on the exposure draft, and that exposure draft will come back to the board, and board as per the comments after making necessary adjustment will issue the standard. Now this standard will be applicable on accountant. Mean accountant have to follow these standards in preparation of financial statements. We do not do anything relating to accounting by our own wishes. We have to do accounting as per accounting standards. So this is the process how standard is issued. Where is the process of issuing standards? Yeah, the board publish an exposure draft or public comments being a draft version of the intended standards. Following the consideration of comments, revise the draft, and board publish the final text. At the stage of board may issue discussion paper to encourage comments, and then the standard is defined. So what are those bodies? IFRS Foundation is the supervising body for the IASB that will order to the board to issue standard and is responsible for governance issues and ensuring each member body is properly funded, mean they are working properly. What is board? IASB is an independent standard setting board, mean here the IASB will define or prepare the standard. Its members are responsible for the development and publication of IFRS or IAS. In old time, the accounting standard name was IAS. Now the accounting standard name are IFRS, International Financial Reporting Standards. So what is the IFRS Interpretation Committee? IFRS IC reviews widespread accounting issues on a timely basis and provide authoritative guidance on these issues. Mean they will guide, provide help how to comply the standards. And advisory will provide advice to the board regarding any amendments, changes in the standard. The council is a formal advisory body of the board and foundation. It is comprised of wide range of members who are affected by the board's work, and their objective is to advise the board, mean IASB, on agenda decision and priorities in their work, informing the board of view of council and regard measure standard setting process, giving other advice to the board on the trustees. There is another concept called company ownership and control, mean company is a separate legal entity. Company owners are shareholder, mean shareholders are the owners, and who is managing the company? The management of the company is directors, and they are controlling the company, and both the managers and owners objectives are different, they are not same. What the shareholder want? They want high return, mean dividend, and they also want a high share price. What directors want? They want high pay. They want high bonus. As well as directors want to keep some money as a reserve. Means shareholder want all the profit should be put into their pocket through dividend. But directors need to keep some part of profit to face uncertain future events. They need some part of profit to face uncertain future events. Mean they prefer some part of profit should be keep as a reserve. Reserve mean retained earnings. So that in case of any issue in future, they can manage those issues from this reserved money. So that's why the objective of both are different. Now moving towards another concept called corporate governance. What is corporate governance? Corporate governance means the system by which companies are directed and controlled. System means there are different codes, different rules that company need to follow, because these rules will provide direction to the company, mean will help the management how they can manage the company, how they can control the company in best way. The corporate governance means different codes, rules, system that help the management to direct and control the company. And for every listed company, they have to follow corporate governance, mean they have to follow certain rules. Who will define these rules? Stock exchange will define these rules. Because being a listed company on a stock exchange, you have to follow the rules of stock exchange. And those rules are called corporate governance, means system codes that company need to follow, because through this company can be directed, company can be controlled in best way. Why? If companies are following corporate governance codes, this can ensure interest of shareholder, means shareholder investment will be protected. Means shareholder will be having a confidence that can make investment in the company, because company is governed by our rules, by our system. Not only shareholder, other stakeholder will be having a confidence they can have long-term relationship with the company, because company is following a system, mean rules, codes of the stock exchange. If company is not following rules, mean there is no system, there is no corporate governance, shareholder will not be having confidence that like their investment is protected in the company. So through corporate governance, shareholder will be having a confidence like their investment is protected in the business. That's why company need to follow corporate governance codes. By following these, company will be having a direction how to manage the company in best way. So why these corporate governance codes have been defined? I mean, what is the purpose and objective of corporate governance? The purpose is to monitor those parties within a company who control the resources owned by the investor. I mean, the purpose is to control the management directors of the company. And what is the objective? Contributing to improved corporate performance and accountability in creating long-term shareholder value. I mean, through this shareholder value can be managed on a long-term basis. Mean things will be controlled according to corporate governance. Corporate governance will provide guidance how company can be managed in best way, how company can consider best for all. And there are some areas that are covered under corporate governance. There should be effective management. Effective management means there should be executive directors, as well as company should have non-executive directors. Corporate governance says company should have a system of internal control. Internal control means there should be some policies defined in the business that everybody should follow to avoid problems. Oversight of management by non-executive director means there should be non-executive director who will provide their experience. Non-executive directors are experienced person. They are involved in strategy making, decision making of the business. Corporate governance says director performance can be appraised, can be monitored. Director's remuneration should be fair. Financial reporting should be accurate. And constructive relationship with shareholders mean directors need to communicate on regular basis with the shareholders. Shareholder mean owner of the company, mean how you are managing their company, you need to communicate with them. Mean these are some rules of corporate governance. We will learn corporate governance in other different subjects in more detail, especially in audit paper at skill level. Who define corporate governance? Stock exchange. And UK Stock Exchange corporate governance codes are UK corporate governance codes of 2018. Mean the companies in UK have to follow UK Stock Exchange codes. And UK Stock Exchange codes are naming UK corporate governance codes. In America, companies have to follow America Stock Exchange codes, and those codes are called Sarbanes-Oxley Act. US, United States mean America. So UK company have to follow UK corporate governance codes. American companies have to follow Sarbanes-Oxley Act. And this chapter is completed now. Now we are moving towards remaining MCQs. 23. Which of the following item in the IFRS Advisory Council is responsible for? Advisory Council. To give advice to the IASB to the trustees? Yes. And to give advice to the IASB on agenda decision? Yes, both are accurate. A and B. 24. We have covered. 25. Which of the following is the most obvious means of achieving public oversight of corporate governance? The company establishing a comprehensive website, that's why corporate governance are defined? No. Publication of annual reports and accounts? Yes, corporate governance says company should produce true accounts. Press announcement of all significant developments? Have we learned anything regarding press? No. Shareholder access to annual general meeting? No, there is nothing we have read about this. So B, we can say this is the purpose of corporate governance. 26. Which body is responsible for the issue of International Financial Reporting Standard, mean IFRS? Who will issue? Advisory Council, IFRS IC Interpretation Committee, the International Accounting Standard Board, IASB, or the European Union? Who defines accounting standard? The board. Because council will provide advisory regarding amendments. Interpretation committee will interpret the standards. In European Union, we haven't studied. 27. Are the following statements relating to IASB, International Accounting Standard Board conceptual framework for financial reporting, true or false? It is a financial reporting standard. It is a financial reporting standard. The framework is a financial reporting standard. No, it's a guidance rather than financial reporting standard. Financial reporting standard is IAS, IFRS. It assists in developing IFRS based on consistent concept. Yes. It assists prepares in developing consistent accounting policies when no standard applies. Yes. It assists all parties in understanding and interpreting IFRS standards. Yes. These are the purposes of framework we have learned. 28. Who is responsible for the preparation of annual financial statements of a limited liability company? Who is responsible for preparing financial statement? The chairman of the board of directors, the board of directors collectively, the finance director, the external auditor. Is All board of directors, all directors collectively responsible for preparation of financial statements. Auditor have to check. Finance director is a part of director. But who is mainly responsible? All directors are responsible to prepare financial statements, not a single director. 29. Which of the following statement best explain director's responsibility in relation to conflict of interest? Mean if there is a difference between objective of the directors, mean interest of the directors and company, that will be called conflict of interest. That may arise between personal interest of director and those of the company. It is illegal for a conflict of interest to arise between the personal interest of a director and those of the company. No, it's not illegal. Sometimes it arises. Means sometimes director consider their best interest that is different than company's interest. A director must resign immediately as soon as they become aware of a conflict between their personal interest and those of the company. No, he should not resign. A director must disclose a conflict between their personal interest and those of the company as soon as they become aware of it. Yes, they should disclose to the other directors. They should disclose to the shareholder. A director can choose whether or not to disclose. No, he must disclose. So option C is correct. Question number 30. Which of the following statement relating to company directors' responsibilities are true? Directors are collectively responsible for the preparation of annual financial statements. Yes, it is true. Directors are always personally responsible for the financial loss incurred as a result of fraud or error in the company accounting costs. No, they are not personally responsible for losses. All directors are legally required to hold a professional accounting or business qualification. No, this is not required. They should have accounting or business qualification. No. Directors are collectively responsible for ensuring that the company maintains adequate accounting records. Yes, to maintain records, to prepare financial statements, it is their responsibilities. So 1 and 4 are accurate and other are not accurate. 31. Who is responsible for ensuring that the financial statements are issued to shareholders and other stakeholders entitled to receive them? Who is responsible? Board as a whole mean all the directors. Where is all the director option? D. 32. Which of the following statement contains a definition of corporate governance? System by which companies are directed and controlled. It is a framework that set out objective and concept of financial reporting. No, that is a conceptual framework. It is a collective term for all currently valid IFRS standards. No. It is a system by which companies are directed and controlled. Yes. It is a collective term for the principle and practice used by external auditor when auditing an annual. No, no, no. C is corporate governance definition. System by which companies are directed and controlled. 33. Which of the following statements explain the concept of consistency? Policies should be consistent year to year in relation to the preparation of the annual financial statements. Consistency relate to the language and terminologies used in annual financial statements from year to year. No, not terminologies, language, policies. Consistency relate to the presentation and classification of information in the statement of profit or loss and a statement of financial position throughout the year from year to year. No, not the presentation and classification only. Consistency relate to presentation and classification of items. Yes, items in the financial statements, including the disclosure notes to the financial statements throughout the year and from 1 year to year. Items mean account balance. Yes. What is D? Consistency relate to the application of IAS, IFRS standards from year to year. No, standards we need to follow. This is not consistency. Consistency mean all items, mean policies relating to account balance classification, presentation should be same. So C is the correct option. In 34, identify whether each of the following characteristics is a fundamental qualitative characteristics or enhancing qualitative characteristics of user full financial information according to IASB conceptual framework for financial reporting. So there were two fundamental qualitative characteristics: relevance and faithful representation. Relevance and faithful representations. So comparability is fundamental or enhancing. Enhancing. Timeliness, enhancing. Faithful representation and relevance, two were fundamental. So this is fundamental and understandability is enhancing. Number 35. Which of the following statement is correct? The going concern concept guarantees that a business will continue in operational existence for at least 12 months after the reporting date. No, there is no guarantee. Going concern mean that business will continue in next foreseeable future. There is no guarantee. To comply with the law, the legal form of transaction must always be reflected in the financial statements. No, not legal form, economic reality which should be reflected in financial statement. If a non-current assets initially recognized at cost is revalued, the surplus must be credited to statement of cash flow. No, we will learn this in future. The surplus must be credited to other comprehensive income, not cash flow. D, in times of rising prices, the use of historical cost accounting is tend to understate asset and overstate profit. So this is the correct option, but we will understand this in future. Currently, we don't have knowledge about historical cost and revaluation. So leave this for now. This is not relevant to chapter 1 and chapter 2. Number 36. According to IASB conceptual framework for financial reporting are the following characteristics that enhance the useful of financial information or not. Mean whether they are enhancing qualitative characteristics or not. So two were fundamental: relevance and truthful, faithful representation. The other were enhancing. So relevance is enhancing or not? No. Comparability, yes, enhancing. Truth, faithful representation, no. Verifiability is enhancing. 37. Which of the following statements best explains the principle of a faithful representation in relation to the preparation of annual financial statements? Financial statements should be accurate, should be true. Transactions are presented any way that is considered appropriate. No, not anyway. Transactions are presented in such a way as to maximize profit for the year. No, no, no. Otherwise, management will understate the expenses, overstate the profits, incomes. Transactions are presented in such a way to maximize asset value in statement of financial position. No, asset should not be overstated. Transactions are presented to reflect their commercial substance, economic reality of a transaction rather than their legal form. Yes, this is the substance over form concept. Because by following this concept, financial statements will be faithfully representation mean accurate. 38. Which accounting concept requires non-current assets to be valued at cost less accumulated depreciation rather than at their enforced saleable value? Prudence. Prudence says asset income should not be overstated, expenses liability should not be understated. Relevance financial statements should be produced relevant to the records. Comparability should be compared with previous year. Going concern. Yes, going concern basis says non-current assets, current assets should be valued separate. So we can say D option. And 39, which of the following pairs of items are the two fundamental qualitative characteristics of useful financial information: relevance and faithful representation? First, relevance and prudence, no. Relevance and faithful representation, yes. Faithful representation and materiality, no. Faithful representation and comparability, no. Comparability is enhancing. Number 40. Which of the following statement concerning the exercise of prudence is correct? It means that asset and income are not understated. No, they should not be overstated. This is wrong. It allows for the overstatement of liabilities or expenses. No, it doesn't allow. It says expenses, liabilities should not be understated. It requires asymmetry between the recognition of asset and the recognition of liability. No, there is nothing like that. It requires a caution when making judgment under condition of uncertainty. Yes, you need to be caution while making a judgment. Assets, income should not be overstated and liabilities, expenses should not be understated. This we have read under prudence concept. So that's enough. For chapter 1, chapter 2, we have covered all the MCQs relating to those chapters. First 40 MCQs, and we have covered chapter 1 and 2. Hopefully, we will meet in next class with chapter 3 onward. Is that fine? So see you in next class.